Hello traders, I hope you are profitable. Today I want to teach you a simple strategy based on the CCI indicator signal. Often in life the right action is the hardest to take. The same dynamic occurs in trading. For most traders it is extremely difficult to buy tops and sell bottoms because from a very early age we are conditioned to look for value and buy cheap while selling dear. That is why although most traders proclaim their love for trading with the trend, in reality the majority love to pick tops or bottoms. While these types of turn trades can be very profitable, and show you several setups that succeed with this approach, turn trading can sometimes seem like a Sisyphean task as price trends relentlessly in one direction, constantly stopping out the bottom and top pickers. Sometimes it is much easier and far more profitable to go with the flow. Yet most traders are still reluctant to buy breakouts for fear of being the last one to the party before prices reverse with a vengeance. How can we trade breakouts confidently and successfully? Do the Right Thing is a setup designed to deal with just such a predicament. It tells the trader to buy or sell when most are averse to doing so. Furthermore, it puts the trader on the right side of the trend at a time when many other traders are trying to fade the price action. The capitulation of these top and bottom pickers in the face of a massive buildup of momentum forces a covering of positions, allowing you to exit profitably within a very short period of time after putting on a trade. Do the Right Thing employs a rarely used indicator in FX called the Commodity Channel Index, CCI, which was invented by Donald Lambert in 1980 and was originally designed to solve engineering problems regarding signals. The primary focus of CCI is to measure the deviation of the price of the currency pair from its statistical average. As such, CCI is an extremely good and sensitive measure of momentum and helps us to optimize only the highest probability entries for our setup. Further in the direction of the move before new prices finally put a halt to the advance or the decline. Rules for the long trade. 1. On the daily or the hourly charts place the CCI indicator with standard input of 20. 2. Note the very last time the CCI registered a reading of greater than plus 100 before dropping back below the plus 100 zone. 3. Take a measure of the peak CCI reading and record it. 4. If CCI once again trades above the plus 100 and if its value exceeds the prior peak reading, go long at market at the close of the candle. 5. Measure the low of the candle and use it as your stop. 6. If the position moves in your favor by the amount of your original stop, sell half and move stop to break even. 7. Take profit on the rest of the trade when position moves to 2 times your stop. Rules for the short trade. 1. On the daily or the hourly charts place the CCI indicator with standard input of 20. 2. Note the very last time the CCI registered a reading of less than minus 100 before poking above the minus 100 zone. 3. Take a measure of the peak CCI reading and record it. 4. If CCI once again trades below the minus 100 and if its value exceeds the prior low reading, go short at market at the close of the candle. 5. Measure the high of the candle and use it as your stop. 6. If the position moves in your favor by the amount of your original stop, sell half and move the stop on the remainder of the position to break even. 7. Take profit on the rest of the trade when position moves to 2 times your stop. Now let's take a look at how this setup works on the longer and the shorter time frames. In this daily chart of the euro to US dollar pair we see that the former peak high above the CCI plus 100 level was recorded on September 5, 2005, when it reached a reading of 130.00. Not until more than 3 months later on December 13, 2005, did the CCI produce a value that would exceed this number. Throughout this time we can see that euro to US dollar was in a severe decline with many false breakouts to the upside that fizzled as soon as they appeared on the chart. On December 13, 2005, however, CCI hit 162.61 and we immediately went long on the close at 1.1945 using the low of the candle at 1.1906 as our stop. Our first target was 100% of our risk, or approximately 40 points. We exited half the position at 1.1985 and the second half of the position at 2 times our risk at 1.2035. Our total reward to risk ratio on this trade was 1.5 to 1, meaning that if we were merely 50% accurate, the setup would have positive expectancy. Note also that we were able to capture our gains in less than 24 hours as the momentum of the move carried our position to profit very quickly. For those traders who do not like to wait nearly a quarter of a year between setups, the hourly chart offers far more opportunities of the "do the right thing" setup. It is still infrequent, which is one of the reasons that makes this setup so powerful. The common wisdom in trading is, the rarer the trade the better the trade. Nevertheless, it occurs on the hourly charts far more often than on the dailies. In the above example, we look at the hourly chart of the euro to US dollar between March 24 and March 28 of 2006. At 1 p.m. on March 24, 2006, the euro to US dollar reaches a CCI peak of 142.96. Several days later at 4 a.m. on March 28, 2006, the CCI reading reaches a new high of 184.72. We go long at market on the close of the candle at 1.2063. The low of the candle is 1.2027 and we set our stop there. The pair consolidates for several hours and then makes a burst to our first target of 1.2103 at 9 a.m. on March 28, 2006. We move the stop to break even to protect our profits and are stopped out a few hours later, banking 40 pips of profit. As the saying goes, half a loaf is better than none, and it is amazing how they can add up to a whole bakery full of profits if we simply take what the market gives us. Now let's look at some short examples. Here is an example of a short in US dollar to Swiss franc trade on the dailies that employs this approach in reverse. On October 11, 2004, US dollar to Swiss franc makes a CCI low of -131.05. A few days later, on October 14, 2004, the CCI prints at -133.68. We enter short at market on the close of the candle at 1.2445. Our stop is the high of that candle at 1.2545. Our first exit is hit just 2 days later at 1.2345. We stay in the trade with the rest of the position and move the stop to break even. Our second target is hit on October 19, 2004, no more than 5 days after we've entered the trade. Total profit on the trade, 300 points. Our total risk was only 200 points, and we never even experienced any serious drawdown as the momentum pulled prices further down. The key is high probability, and that is exactly what the "do the right thing" setup provides. Here is another example of a short-term trade, this time to the downside in the euro to Japanese yen. At 9 p.m. on March 21, 2006, euro to Japanese yen recorded a reading of -115.19 before recovering above the -100 CCI zone. The "do the right thing" setup triggered almost to the T 5 days later at 8 p.m. on March 26, 2006. The CCI value reached a low of -133.68 and we went short on the close of the candle. This was a very large candle on the hourly charts, and we had to risk 74 points as our entry was 140.79 and our stop was at 141.51. The majority of the traders would have been afraid to enter short at that time, thinking that most of the selling had been done. But we had faith in our strategy and followed the setup. Prices then consolidated a bit and trended lower until 1 p.m. on March 27, 2006. Less than 24 hours later we were able to hit our first target, which was a very substantial 74 points. Again we moved our stop to break even. The pair proceeded to bottom out and rally, taking us out at break even. Although we did not achieve our second target overall, it was a good trade as we banked 74 points without ever really being in a significant drawdown. Finally, our last example shows how this setup can go wrong and why it is critical to always use stops. The do the right thing setup relies on momentum to generate profits. When the momentum fails to materialize, it signals that a turn may be in the making. Here is how it played out on the hourly charts in Australian dollar to US dollar. Could have been magnified by a factor of 3. Therefore, the key idea to remember with our do the right thing setup is, I am right or I am out. Thank you for watching. Please support us by liking and subscribing, and your opinion is very important to us.